Jim, we got the Dow down 180 to start the session. Let's get to Bob Pisani this morning. Hey, Bob.
Morning, guys. Happy Tuesday. 2-to-1 declining to advancing stocks. This broadening out idea is very popular, but it's hard to do right now. You can see this in the sectors. Again, today, tech is generally leading, consumer discretionary generally leading. A little bit of a pop out in consumer staples. That's nice to see. Kimberly-Clark, Clorox advancing. But again, you see the laggard sectors, energy, healthcare. We've been waiting for these to sort of come forward and still having a hard time. It's the one sort of weak link in the whole rally we've seen. Look at the S&P gainers, kind of the same gainers that we've seen the last few weeks. As Jim mentioned, there's Tesla, there's NVIDIA, and there's the home builders all breaking out. And if you look at the laggards, we keep waiting for industrials to broaden out, materials to broaden out, some of the regional banks to broaden out, even energy stocks like SLB to broaden out. And again, you see hard for that to happen. Again, sort of the weak link that we've had out there. So the big debate over the weekend, what would it take to have a real serious pullback? And I don't mean a 5% decline in the S&P. We're up 15% on the year. You know you're going to get a 5% pullback. Everybody knows that. What would it take to go back to zero with being up 15%? And everybody seems to agree. You got to believe the soft landing isn't going to happen. To do that, you've got to be a believer that we're going to have a big drop in employment, that the earnings situations are going to crater. Right now, we're about even compared to 2022. You'd have to believe they're going to drop 10% or more. And you have to believe interest rates are going to move up even more than the Federal Reserve thinks or wants the interest rates to rise. That's a lot to ask for the market to go to zero here. And we have seen a very strong history in the first half of the year. When the first half is really strong, the second half tends to be strong. Look at this, the S&P 500. We're up 15% this year. It's been up 15% or more in the first half 10 times since 1980. That's 42 years. It closed higher for the full year 10 out of 10 times. So here's your question. What would it take to go to zero? It's a powerful momentum here. The average gain for the full year, those 10 times it's happened, is 23%. So it's on average gained more going into the close. These are powerful historical trends. You deal with probabilities, and 10 out of 10 is a pretty good probability. Now, the rally's narrow. We all know this. The simple look at the S&P 500 versus the average stock. There's the RSP. So the orange line is the equal weight S&P. The white line is the S&P 500. You see, when the tech rally started in March, it pulled away. We're up 15% on the S&P. Average stock up 5% right now. So important thing here is that the rally has been strong, but it's been narrow here. If you look for advances elsewhere, yes, the S&P 500's advanced decline line has been fantastic, above the February highs. But mid-cap, small-cap rally, it's better in June, but still not great. So let's just call it modest here. If you want something to worry about, Carl, the biggest thing that I see out there is the competition with stocks, with bonds and with cash out there. FT had a great story over the weekend pointing out that cash money markets still are near 5%. Short-term treasuries are still near 5%. And the earnings yield on the S&P, that's the inversion of the earnings situation, is about 5%. What that means is bonds, treasuries, and cash are still very heavy competition for stock. And, Carl, I think that's still going to be an issue.